Hi, I'm Nathan Cross, Managing Director of JNC Property. I started JNC Property to assist financial planners and accountants to help their clients successfully invest in property. In the many years of my dealings with clients of these businesses, I find that people are most comfortable investing in property over other asset classes. The problem that I generally find is that most don't really spend enough time researching or educating themselves before launching into investment decisions. The education of our clients really is important to us, as it helps you to build confidence and gives you a sense of ownership when you make an investment decision. One of the most important things for me with all of my clients is that you'll be able to sleep at night, knowing that the property you purchase matches your risk profile and is suitable for your situation and your investment strategy. I don't adopt a one-size-fits-all approach, which is the whole purpose of doing this video. Today, I'm going to talk about several areas around Australia in order to give you an insight into the many property markets in and around our country. I want you to identify one that you feel comfortable with and one that you'd be happy to purchase a property in. That's the key objective for today. The main objective when investing in property, when you're starting out, should be capital growth. And this is what we focus on. The biggest mistake most people make when investing is that they buy in the wrong location. Most people think that they have to buy in a capital city to get strong growth or to avoid risk. Worse still, a large portion of investors buy close to where they live because they know that area well. In the majority of the time, however, where you live does not double as a good place to invest. Most investors overlook our thriving regional centres because they deem it too risky. They overlook these areas simply because they don't understand or appreciate what's happening in and around these local economies. Unfortunately, this mindset is costing them tens, if not hundreds of thousands of dollars in missed opportunity, or what I like to call opportunity cost. Truth be told, it's the regions that are providing investors the greatest opportunity at the moment in our property markets. If we take a look back over the past few years, 2010, 2011 and again in 2012, it was our key regional centres that had the highest capital growth throughout Australia. While some regions have been experiencing double-digit growth the past few years, most capital city markets have been in decline. This strong growth in our regions is largely underpinned by affordability, population growth, sustainable employment, and the subsequent high incomes per capita created from this ongoing employment. Now, these high incomes are a direct result of the many new industry and infrastructure projects currently underway in the regional centres, and in most part, directly off the back of the resources sector. While many commentators and economists are quick to call the end of the mining boom, when you actually scratch the surface and look at the facts, the real story is vastly different to that of what's being reported. It's well known that China and India combined are growing faster than all of Europe combined, and their investment in Australia's resource sector is significant, to say the least. Australia is entering into a long-term sustained period of growth in our resources sector. And whilst we will see some economic benefits flow into our capital city markets, like Brisbane and in particular Perth, it really is the regional centres that will get the biggest boost of all. A strong resource sector means strong employment and population growth, and this creates more competition for housing. I mean, just think about it for a moment. Lots of people earning large incomes, living in areas where housing is affordable and is in short supply. That's supply and demand, isn't it? In fact, the simplest principle of economics tells us that when demand exceeds supply, prices rise. You'll be happy to know that this is actually occurring in quite a few areas in Australia right now. Even if it's not prevalent where you are sitting right now watching this video or where you live, you can take comfort knowing that there are many opportunities around many different markets within Australia at this very moment. In our regional centres, we are seeing more people competing for a limited number of properties, which in turn is placing strong upward pressure on rents and property prices. Let's now take a look at some of the areas that I believe are set to outperform the market this year. Let's start with Emerald. Emerald in central Queensland is one market in particular that is set to do well over the coming years. It had good run during 2004, 05, 06 and even 07, and then like most markets, it paused from 2008 onwards during the GFC. It's a very self-sufficient economy in its own right, with agriculture and mining quite prominent as the major industries. Whilst it is a self-sufficient economy, it's really what's about to occur to the west of Emerald at a place called Alpha in the adjacent Galilee Basin that gives Emerald great prospects for future capital growth. What's happening in the Galilee Basin? Well, we have 3 or 4 major companies developing thermal coal mines out there to be railed up to Bowen and sent out offshore to supply power over to India. We have GVK doing a joint venture development with Gina Reinhardt. We also have the Adani Group, who owns all the power stations in India, and we have Clive Palmer as well, looking to develop coal mines in the Galilee Basin. Now, what does that actually mean for Emerald? Well, what the problem Emerald will face over the coming years is a severe housing shortage. Where these mines are currently proposed to be developed, there is really no infrastructure around there. There's limited housing and it's a limited population. Emerald is the closest regional centre to any of those mines. In actual fact, as part of some of the development approvals for these mines, there will be new road infrastructure leading directly into Emerald. Emerald historically has vacancy rates well under 1%, and when any new large-scale projects occur, it sends them down to critical levels. Rents in Emerald can generally fluctuate. A 4-bedroom home can fetch as high as $1,200. Since the soft downturn we saw just prior to Christmas in 2012, we saw rents come down by $200 to $300 per week. This can occur in regions like this. However, with the commencement of new projects in 2013 and beyond, these rents and subsequently property prices are set to soar once more. That then takes me to Bowen, because the Bowen and Emerald property markets are intrinsically linked. The mining to occur in the Galilee Basin, just west of Emerald, is really linked to the whole Bowen story because, as I said earlier, the coal will be railed up to Bowen and sent out through the port at Abbott Point. Abbott Point is about 25 kilometres north of Bowen. Now, to facilitate the exporting of all this new coal means that they need to build 2 or 3 new terminals immediately. The current facilities at Abbott Point can certainly not cope with the increased activity out of Abbott Point. What does that mean for the property market in Bowen? Well, it means hundreds, if not thousands, of new jobs directly in and around the Bowen market. Now, Bowen, much like Emerald, generally has vacancy rates around 1% or less. And just so you know, an acceptable vacancy rate is around 3%. That's kind of the national acceptable level. Anything below 3% is classed as a pretty decent rental market. 1% vacancy rates are excellent, and investors should take note of areas with those vacancy rates. Now, once Bowen gets the influx of new workers to carry out the construction of the new coal terminals, more people moving to town needing accommodation, the guys who are working on the terminals will be carrying 6-figure salaries, more money to spend in the local economy, pushes up rents, pushes up property prices, causes inflationary pressures in that local economy. And that's why Bowen is set to really undergo some exciting times over the next few years. As we scroll down the Queensland coast, we get down to Rockhampton. Rockhampton, obviously the big brother of Gladstone, but it certainly has been overshadowed by its little brother over the past few years in regards to its property market. I believe Rockhampton is really primed to benefit from the ripple effect. We're seeing strong growth and strong industry presence in Gladstone right now, yet Rockhampton hasn't really seen the benefits flow into the property market. Rockhampton's got a very vast and diverse economy across many sectors. Agriculture again, tourism, but it's really the key service centre for all of central Queensland. If Gladstone is the industrial hub or muscle town, then Rockhampton is that key service centre for the Bowen Basin. Moving forward, I expect to see Rockhampton's property prices increase, certainly not to the levels that we've seen in Gladstone, but I think what we will see is the ripple effect start to take shape in Rockhampton, and we should start to see some steady growth from this point forward. As we move down to Gladstone, we really get to the epicentre of really what is the industrial hub for Queensland, and if not Australia. Gladstone is set to do well over the coming years, in my opinion, for 3 key letters, and that's LNG, or liquefied natural gas. Liquefied natural gas, it's a burgeoning industry for Queensland, and really Gladstone is going to be the epicentre of this industry. Well, what is liquefied natural gas? Well, essentially it's coal seam gas that gets converted and condensed down to about 1/600th of the size, which then obviously gets sent offshore over to the many Asian countries. The coal seam gas is currently being mined out in the Surat Basin in Queensland, just west of Toowoomba, and I'm going to talk about that shortly. But back to the Gladstone market. Many experts will try to tell you that the Gladstone market has had its day, that property prices have risen dramatically and future growth is unsustainable. Yeah, I tend to agree. But however, there was a recent Central Queensland University study conducted by Professor John Rolfe. And in this study, he discovered the impacts of large-scale projects and the effect that they have on small regional communities. Bearing in mind Gladstone has a population currently of around 30,000 people. In Professor Rolfe's report, he said that with the ongoing and operational jobs directly from the liquefied natural gas industry and the subsequent service industries created from this, he believes that the underlying shortage in housing will see the median house price in Gladstone grow by between $200,000 and $350,000 over the next 5 years. I don't know about you, but as an investor, I would like to invest in a town like that. As we head south, we come to Brisbane. And look, while Brisbane's not a market that I actively promote as being one that's ripe for growth, it's certainly a market whereby investors could position themselves for future growth. I think if we're talking about capital cities, you would really have to focus on Perth or Darwin, as it seems to be their time for growth. However, I tend to get the feeling that Brisbane's time could be 2014 and beyond. We have seen some price corrections in Brisbane, and we are seeing rental vacancies tighten, which is a good sign. I just don't think 2013 will be the year for Brisbane. Heading west from Brisbane out to Toowoomba, this is an area I'm really keen on. It's a very strong and diverse economy, it's affordable, and it's quite a low risk investment. And yet, it's potentially going to receive a major spin-off from the resources sector via the mining in the Surat Basin. I spoke about coal seam gas earlier. Coal seam gas, of course, being sent up to Gladstone, converted to liquefied natural gas. We've got places out in that Surat Basin like Miles, Roma, Dalby, Chinchilla. Those towns have actually received strong growth. And in actual fact, their property markets are really linked to Gladstone. However, Toowoomba, on the other hand, hasn't yet actually seen any capital growth. If we look at their market over the past 3 years, it's actually been either quite flat or in some instances declining. What we have seen the past 6 to 9 months is that rental vacancy rates have tightened and rental prices are actually starting to rise, and quite significantly in some cases. Historically, once you see rents rise, property prices tend to follow shortly after. And I think that presents a timely opportunity for Toowoomba. It's certainly one market that, as I said earlier, I'm very bullish on, and I think for the risk-averse investor, it's one that you should certainly consider. This now takes me over the border into New South Wales. And whilst there's not a lot of markets in New South Wales that should be considered for investment, there's a couple of standouts in my mind. And again, like I said at the very start, they're really regional centres as opposed to a mining town or a capital city. I'm going to start with Gunnedah. Now, many of you may not have heard of Gunnedah. Of course, it's home of Miranda Kerr, but that's not the reason I want to talk about it. It's around an hour or 45 minutes west of Tamworth, which has got a population of about 60,000 people. But Gunnedah, around that 45 minutes west, population of around 12,000 people. Again, very strong and diverse economy in its own right, but it's really the resource sector that's going to give Gunnedah a major boost over the coming years. The nearby Gunnedah Basin has some of the largest coal reserves and coal seam gas reserves in Australia. And it's widely known within the local region there that the coal is much easily accessible than that of the Hunter Valley. It is known by some that Newcastle is in fact the largest port in the world for coal. And it's also quite obvious that most of that coal comes from the Hunter Valley. It's one of the great areas in Australia for coal mining. However, just around 2 hours north of there in Gunnedah, we're about to see major coal mining occur. Whitehaven Coal has been in the news in 2012 as it's gained New South Wales Government approval for its Maules Creek project at a place called Boggabri, just north of Gunnedah and just south of Narrabri. Now it's really these two areas, Gunnedah and Narrabri, that are set to benefit from this Maules Creek project. The project, it's around $650 million investment and it's set to create about 700 construction jobs. In addition to that, it will create around 600 operational jobs, and it's reported that there will be around another 750 subsidiary or service jobs created from this mine. Now that might sound like a lot, but when you put that into a community that have only got 12,000 people and there's already an underlying shortage of suitable housing, what we're going to see is upward pressure on rents and therefore the subsequent upward pressure on property prices. Gunnedah is certainly one area that I like moving forward. Yes, it's more of a mining town, but it is less than an hour to a large regional centre in Tamworth, and there is major investment mooted for there. During 2009 and 2010, Chinese company Shenhua Watermark Coal spent around $220 million acquiring around 43 farms. They intend to start coal mining from 2015 onwards. Now, major companies like this don't go and buy 43 farms and spend over $200 million if they're not serious. These projects, and the one I mentioned before, Maules Creek, will greatly influence Gunnedah, and there's not too many other projects around in Australia of that magnitude that will have such an impact on such a small town. As we head south, we get to the Hunter Valley. And look, the Hunter Valley, it's one of my favourite areas for investment. Not too many areas in Australia, in my opinion, tick every box, but I think the Hunter Valley does that. It has lifestyle appeal. You have the wineries, you have the horse studs. Tourism is a $1.5 billion a year industry. You've got lifestyle appeal in addition to the wineries. Newcastle is close by. You're less than 2 hours to Sydney. But it's also, again, the mining that's occurring around Muswellbrook and Singleton that gives the Hunter Valley region that potential boost for growth. The beauty of the Hunter Valley, much like Toowoomba, is that you get to invest in a low risk type area or region, yet have a spin-off or invest in an area that has influence from the resources sector. You can choose to invest in places like Maitland or Cessnock, which is closer to Newcastle, or you can head northwest and get to places like Singleton or Muswellbrook, where rental returns get higher and property is slightly cheaper. We've seen property do quite well in the Hunter Valley over the last couple of years. And to be honest, I can't see that trend stopping anytime soon. It's a very strong region, it's got high incomes per capita, lots of new infrastructure projects going on, in particular the $1.4 billion Hunter Expressway, which is due for completion later this year, creating hundreds of jobs, and again, a lot of those jobs carrying quite large salaries. The Hunter Valley area is one that I really like. And if you're sitting at home a little bit risk adverse, it's one, much like Toowoomba, that you should certainly consider. I'm going to go down to Victoria now. Now you might find it strange that I'm going to Victoria, and to be honest with you, there aren't a lot of areas in Victoria right now that I would actually suggest for investment. The Melbourne market had a very good run from 2007 through to about 2010, and at the moment is actually in decline. Lots of vacancies, etc. The beauty about the property market is though, there is not one property market. You can travel an hour west of Melbourne and get to a place called Ballarat, and the story is vastly different. I guess the best way to class Ballarat for people who have never been there is that it's the Victorian version of Toowoomba. It's around the same size, it's got about 100,000 people, and it's a very strong and diverse economy. Now what we're seeing at the moment is a lot of people make a lot of money in Melbourne over the past few years, and they're starting to cash out and head out to more affordable regions like Ballarat. The beauty with Ballarat is that, as I said earlier, it's only around an hour away. And as the state government puts more money into transport infrastructure, that hour is getting closer and closer together. Ballarat has a lot going for it over the next few years. Starting in 2015, there is the creation of the new Ballarat West Employment Zone. This zone, to be created over the next 20 years, is set to provide $5 billion annually to the gross domestic product of Ballarat. With low vacancy rates and the new rail and road transport infrastructure, in addition to the Ballarat West Employment Zone set to create over 10,000 new jobs, we believe that the Ballarat property market is set to do well over the coming years. Look, we don't see huge growth or short-term spikes that we can see in some of the other regions, but Ballarat is one of those areas, again, much like Toowoomba, that should receive steady, ongoing, sustainable capital growth over the next few years. So look, that's probably 8 markets in Australia that I would happily go out and invest in property right now. And in actual fact, I'm doing that in a number of those. You'll notice that these properties, or these areas rather, are situated on the eastern seaboard. This is not to say that Perth is a bad market to invest in, quite the contrary. I just focus on the eastern seaboard because I've been to each of these areas, I've been on the ground there, and I know their property markets, and hence I can safely suggest to you that they're good places to invest. Remember, educating yourself when investing is the most important thing to do, and I hope this short video has enabled you to build some confidence, to educate yourself, and to therefore help you take that next step when you're investing in property. My name's Nathan Cross, and I look forward to catching up with you soon.